What if the gold standard didn't die once, but twice? First in a panic with the lights off in 1914, and then again on a summer Sunday in 1971, with TV cameras rolling and the president smiling. 2 deaths, 2 funerals, 1 ghost that still haunts our money. If gold was the anchor that kept prices, currencies, and empires steady, who cut the chain, and why? This is Dollar's Dance, in which we rig the money with simple stories to reveal the truth, and it's all about money. Today we're opening the case file, how the gold standard really died, 1914 to 1971. Not the myth, the mechanism. Before there were algorithms and swap lines, there was a simpler promise. A dollar was a weight of gold. The gold standard, at least the romantic version, was 2 sentences long. The central bank would convert paper into gold at a fixed price. And if gold flowed out because a country bought too much abroad, the rules of the game said raise interest rates, slow the economy, pull prices down, and the gold would come home. Simple? It worked, until it didn't. Gold was a mechanism, a myth, and a mood. The mechanism measured value. The myth said governments would obey the rules. The mood was confidence that others would do the same. In 1914, all 3 met a test they couldn't pass. Act 1. The first death, 1914. It started with telegrams, not speeches. In July and August 1914, Europe mobilized for war. As troops moved, so did money. Investors sprinted into gold and dollars. Banks shut their doors. Stock exchanges closed. Governments quietly did the unthinkable. They suspended gold convertibility and blocked exports of gold. Britain, the beating heart of the classical standard, issued emergency currency and told the Bank of England to keep the system from cracking. It worked, in the sense that commerce didn't collapse. But the price was simple. The gold standard had been put to sleep. The promise was broken. War swallowed the rulebook. Why it mattered isn't about metal, it's about habit. The classical gold standard, roughly 1870 to 1914, worked. Because central banks were small, governments lived on modest budgets, and labor markets were flexible enough to take their bitter medicine. If gold left, rates rose, prices fell, wages bent, and the adjustment happened without riots or 24-hour news. The anchor bit hard and fast, but modern mass democracy, total war, and the welfare state were coming. They don't bend easily. By 1914, the old rule had met a new world. What followed the war was not a return. It was a remodel disguised as a restoration. Act 2, the interwar comeback. That wasn't 1919-1931. Europe wanted normal. Politicians promised it. Back to gold, they said. Back to stability. But the path they chose made stability a mirage. Countries tried to go back at the old exchange rates, as if 4 years of inflation, debt, and devastation were a bad dream. Britain was the lead character. In 1925, Winston Churchill, as Chancellor of the Exchequer, returned sterling to pre-war parity. Morris dollar back to 486. It sounded noble. It was expensive. British prices and wages were too high for that exchange rate. To defend the peg, the Bank of England had to keep money tight. Exporters suffered, coal miners bled, unemployment lingered. The gold standard, one economist said, was skating on the thin ice of hope. Meanwhile, the US and France hoarded gold like dragons. The Bank of France stabilized the franc at a deliberately cheap rate in 1926, Poincaré's stabilization, and gold poured in. But instead of cutting rates to let the gold circulate, France sterilized it, locking it away so domestic prices wouldn't rise. The Federal Reserve tightened in 1928 to cool a Wall Street boom. Gold rushed to the US too. The rules of the game said, when gold comes in, ease. They didn't. When gold leaves, tighten. They did. The machine started grinding itself. Then the stress fractures went public. In 1931, after a wave of bank failures and a run on sterling, Britain gave up the peg and let the pound float. The headlines read like a betrayal of civilization. Markets were shocked. Then something funny happened. Britain recovered faster. Freed from the gold collar, it could cut rates, devalue, and breathe. The lesson was awkward. Gold might have been the problem. Across the Atlantic, America hesitated, then jumped. In 1933, Franklin Roosevelt declared a bank holiday, ended domestic convertibility, and let the dollar fall. In 1934, the Gold Reserve Act reset the price of gold from $20.67 to $35 an ounce, an official devaluation. The dollar grew cheaper. U.S. prices and output rose. The gold bloc, France, Belgium, the Netherlands, hung on to gold into 1936, suffering deflation and unemployment until they devalued too under the tripartite agreement. By the late 1930s, the interwar gold standard was a costume. It looked like gold, but the rules had already been rewritten. Autopsy of a failed return. So who killed the interwar standard? 3 culprits stand out. Wrong prices, Countries tried to go back to pre-war parities as a matter of pride. But the world was new. That choice forced deflation onto economies with voters. Sterilization. Central banks absorbed gold inflows instead of allowing money and prices to adjust. The self-correction system jammed. Politics. The rules relied on fast wage and price moves that democratic societies resisted. Politicians could count votes. Gold couldn't. If the classical gold standard died of war in 1914, the interwar standard died of denial in the 1920s and 30s. But the gold story wasn't over. It was about to be rewritten on American paper. Act 3. The Second Life. Bretton Woods, 1944-1958. Bretton Woods is the famous part of the story, but it's often misunderstood. The conference in 1944 didn't restore the old gold standard. It built a new system with gold as a prop and the dollar as the star. Call it a gold exchange standard with training wheels. Here's what it promised. Fixed but adjustable exchange rates. Currencies would peg to the dollar, and the dollar would be convertible into gold at $35 an ounce for foreign central banks only, not you or me. Capital controls. Money couldn't dance freely across borders like before. Governments could dam the rivers to keep pegs stable. The IMF as referee. If your peg broke, you could devalue in an organized way, with permission and a plan. The architecture made sense in a world that had just burned. Capital controls gave governments space to rebuild. With American industry intact, the Marshall Plan funding Europe, and war demand rolling into peacetime, the system felt like a fresh start. The dollar became the world's invoice and reserve. Gold sat in the background like a silent guarantor. Riddle at the core. Triffin's dilemma. But the new design hid an old paradox. For the world to hold dollar reserves and grow, the United States had to supply dollars by running deficits or lending abroad. The more dollars it supplied, the less gold it had per dollar. The world asked for more dollar IOUs. The promise to convert those IOUs into gold at $35 became harder to keep. If the U.S. stopped supplying dollars to defend its gold, the world would run short of reserves and the system would suffocate. If it kept supplying dollars, confidence in the gold promise would erode. That tension, first spotted by economist Robert Triffin, wasn't a bug. It was the blueprint. Act R4. The cracks. 1958-1968. By the late 1950s, Europe was back on its feet. Currencies became fully convertible for trade. The dollar shortage flipped into a dollar glut. American spending abroad, military bases, Vietnam, multinationals pumped dollars into foreign hands. New plumbing, the Eurodollar market, let banks outside the U.S. create dollar deposits offshore. Dollars were multiplying far from Washington's line of sight. The $35 promise started to wobble. Private gold markets sniffed a gap between the official price and reality. To defend the official price, the U.S. and its allies formed the London Gold Pool in 1961. Central banks would combine gold to sell into the market and keep the private price near $35. It worked until it didn't. As European economies ran surpluses, they debated whether to keep dollars or ask for gold. Charles de Gaulle was the most theatrical. In 1965, he denounced the exorbitant privilege of the dollar and sent a French naval ship to New York to pick up France M's gold. It made for good TV. More requests followed. Meanwhile, Britain devalued sterling in 1967, and the pressure shifted to the dollar. In March 1968, the gold pool broke. The market split in two, a two-tier system. Central banks would still trade among themselves at $35, but private markets could float. It was a polite fiction that bought time. The IMF invented special drawing rights, SDRs, in 1969, paper gold, to ease the reserve squeeze. It was creative. It was also a signal the gold promise was not enough. Act 5. The Second Death, 1971-1973. The end came quickly, then slowly, then all at once. By 1971, the U.S. had less gold relative to outstanding dollar claims than it needed to sustain confidence. Germany floated the mark. Speculators tested every defense. Over a weekend in August, Richard Nixon and his advisors met at Camp David. On August 15th, Nixon went on TV. He closed the gold window. The U.S. would no longer convert dollars held by foreign central banks into gold at $35. He also imposed wage and price controls and a temporary import surcharge. The move was sold as a new prosperity. It was, technically, a default on a narrow promise. The dollar was no longer as good as gold. Negotiations kept the theater alive. The Smithsonian Agreement in December 1971 tried to reset parities, slight devaluations, a wider band to allow currencies to move. But the pressures didn't stop. In 1973, the major currencies floated. By 1976, the Jamaica Accords amended the IMF as Articles of Agreement to recognize floating rates and the official demonetization of gold. The world had moved on. Gold went from anchor to asset, from rule to relic, at least in theory. So who really killed the gold standard? It's tempting to pick a villain. De Gaulle, Nixon, speculators, central bankers. The honest answer is more interesting and more useful. War killed the classical standard. Total war demanded money and minds that no fixed rule could discipline. You can't fight for survival and defend a parity at the same time. Wakai! Democracy and the welfare state killed the Restoration. Voters don't vote for deflationary adjustment when unemployment is high and debt is heavy. The interwar attempt demanded sacrifices people wouldn't make. Sterilization and policy errors jammed the mechanism. France and the US hoarded gold. The Fed tightened into fragility in 1928-29. Then again in 1937, sterilized gold inflows and helped trigger a sharp recession. The rules of the game require both sides to play. They didn't. Triffin killed Bretton Woods. The system asked the US to supply dollars and defend gold at the same time. Over time, those goals became mutually exclusive. The exorbitant privilege came with an exorbitant contradiction. The Eurodollar market and capital mobility loosened the bolts. Dollars multiplied outside the US regulators' reach. Capital controls couldn't corral global finance forever. When money can move faster than policy, pegs snap. Politics delivered the last blow. Nixon chose jobs and growth over a gold promise the public didn't T-vote on and couldn't even T-spend. He read the room and the calendar. Through all of this, gold didn't vanish. It changed jobs. Central banks kept piles of it. It remained a refuge in crises, a signal of distrust, and a way for countries to diversify away from other people's promises. But as an anchor for everyday exchange rates and domestic prices, its authority passed to something else. A mix of independent-ish central banks, inflation targets, and the raw discipline of bond markets. Scenes from the long goodbye picture London, July 1914. A clerk at the Bank of England stamps an emergency note as a gentleman in a top hat asks, "Can I convert this into gold tomorrow?" The answer is a practiced smile. We advise patience. Picture the city, May 1925. Churchill stares at a chart and says, "The pound must be as good as it was." Across town, a miner shakes his head over cold tea. At this price, we can't sell. 2 truths, 1 mistake. Picture New York, 1933. A shopkeeper reads a notice. Gold clauses in contracts are void. Across the street, workers carry signs. "We need jobs, not parity." Picture Paris, 1965. De Gaulle, chin high, declares gold does not change. Behind him, aides check shipping schedules for the Navy vessel headed to New York. Television eats it up. Picture Camp David, August 1971. A small group around a wooden table. "Close the window," someone says. "We'll promise a new, better system." Outside, the Potomac flows past. History bends quietly. What the gold standard taught, without meaning to tuck. Fixed rules are powerful until the world changes. Then the rule either adapts or snaps. Anchors demand symmetry. If you force others to adjust while you protect yourself, your anchor becomes their weight. Credibility takes decades to build, minutes to lose, and years to rebuild. The interwar mistakes taught central bankers to speak carefully and act decisively. The 1970s taught them that credibility once lost is expensive to buy back. Money is memory. The memory of gold, its myth of discipline, still shapes how we talk about inflation and debt. Even people who never saw a gold coin feel the echo. Does any of this matter now? Yes, because every time a country pegs its currency, promises a fixed exchange rate, or pledges a hard rule, it's auditioning for a gold standard in miniature. The same pressures show up. If you peg, do you have the reserves and the political will to defend it? When capital moves faster than your policy can respond, what breaks first? If your anchor requires a recession to hold, will you choose the rule or the vote? Consider modern echoes. Argentina's 1990s currency board tied the peso to the dollar until deficits, capital flight, and politics forced a brutal breakup. The euro is a shared currency without a shared treasury. It survived a sovereign crisis only after leaders built new institutions and promised whatever it takes. Hong Kong defends a dollar peg with a simple rule and a willingness to take pain. Pegs are mini gold standards. The playbook endures. And consider how the system replaced gold's discipline. Instead of metal, we rely on institutions and markets. Independent central banks target inflation. Bond markets price credibility in real time. If a government pushes too far, yields rise. If a central bank blinks too often, expectations drift and currencies slide. It's not as simple as a weight of metal, but it's faster, more flexible, and when it works, more humane. When it doesn't, we feel it quickly. One last twist. Gold didn't die for everyone. For individuals, it remains a store of value with no counterparty, no one else's promise. For central banks, it's a political hedge. For markets, it's a fear gauge. But as the operating system of global money, it failed the test of the modern world: mass democracy, rapid capital flows, world wars, and welfare states. In the end, the gold standard didn't just lose to politics, it lost to time. So how did the gold standard really die? In 1914, it died of war, suspended by necessity, exposed as a fair weather friend. In the 1920s to 30s, it died of denial, restored at the wrong prices, sabotaged by sterilization, suffocated by politics. In 1971, it died of design. Bretton Woods, gold dollar promise collapsing under Triffin's dilemma and the weight of a global dollar. 2 deaths, 1 long goodbye. And a lesson that keeps teaching. Anchors are only as strong as the ship that holds them and the crew that agrees to sail by their pull. If this gave you a fresh lens on why we left gold behind and what replaced it, subscribe. History has the answers. I'll show you where to look.